Well, thanks, everyone. Thanks for showing up this afternoon. This is a big delight for me. My name is Adam Nash. I'm the Chief Operating Officer at Wealthfront. I've been at a lot of technology companies, Apple, eBay, LinkedIn. It's a particular delight for me to have ended up at a company, a great software company, at least one we're trying to build, where it's actually part of my job description to get to work with world-class financial experts like Bert and Charley here. So hopefully you'll feel the same after we go through these questions. I know that you have a lot you probably want to hear from them. We've tried to solicit from some folks good questions to cover some basic material, and then we'll have time at the end for additional questions, if that makes sense. So anyway, Wealthfront is a startup, but we're the largest and fastest growing software-based financial advisor. Probably the first question for both of you is pretty simple, which is, you both had such amazing careers, defining financial expertise for the industry. Why the involvement in Wealthfront at this point? Maybe just a retrospective.
Well, from my standpoint, it was largely because I think most people get just terrible financial advice, and it's too expensive. Most financial advisors charge a very high fee themselves, and they are conflicted in that when they suggest that you buy this or that mutual fund, what's sort of little known is that they usually get a payment from that mutual fund company to put you in that mutual fund. They're high-cost funds, and I've spent my life studying the fact, as the introduction said, that over time, very high-cost mutual funds don't beat the market. Rather, they underperform the market, and that they underperform the market by at least the amount of their excess costs. So you've got costs of the advisor, you've got high-priced funds in what the advisor recommends. The advisor is typically conflicted. And here you have something where, with the advantage of doing this with software and doing this electronically, that you can give unconflicted advice, and we use the funds that I have recommended all my life, low-cost index funds, that competition has now driven down to have very close to zero fees. So we can provide this electronically. It's inexpensive. I think it's as good advice as any high-priced investment advisor will give you. And we can then, particularly for funds that are over $100,000, do things like tax loss harvesting. None of us can control what the stock market's going to do, but the one thing we can control is the things that are controllable, and one of them is costs, and one of them is taxes, and this we can do very inexpensively, electronically, and I'm actually very, very proud to be a part of an organization that I think is doing a great job for people.
Charley?
Well, we differ. Bert would say it's low cost and a much better product, and I would say it's much better product and low cost. Seriously, if you look back over the last 50 years, I think both of us would be truly aggravated by the crowd we know best not doing anything like a really good job, and candidly charging quite large amounts. And a lot of different ways of looking at that, and we can come back to it if you want to, but it is very unsettling to have the crowd that you're part of charging a lot and delivering a little. And so you're looking all the time. And when I heard from Bert that he was involved with Wealthfront, it seemed to me to make a great deal of sense.
Well, I'm glad you mentioned that. You two have known each other for a long time now.
We were born in the same hospital, so it goes back quite a ways.
Yeah.
You want to tell a bit about how you two first met and worked together? I'm sure people would love to hear it.
Do you remember?
Well, I think we have been, of course, the first index fund was founded by a company called Vanguard, And Vanguard now is the biggest index fund provider, and they also provide ETFs, which are basically funds that trade as stocks, and they're basically the ones that Vanguard has are index funds. And Charley and I, for a long period of time, sat next to each other on the Vanguard board. And I think one of the reasons that we got to really like each other is that
we always agreed.
We would, yeah, that was the problem. We would all make a point, and for somehow or other, you and I always agreed. And we sat next to each other, and we would, and if we didn't even talk, we would just sort of nod. So that was how it all started. And my God, it's I don't want to count the number of years, but it was a long number of years, and we became friends and became co-authors because the little book that's been featured is our attempt to put down everything we know in a book that would take an hour and a half to read. And we had a lot of fun doing it together.
That's if you're a slow reader.
If you're a slow reader, right.
That's great. I mean, Bert, this isn't the first time I think you've been at Google. In 2004, I remember when Google went public. It was the big IPO at the time because there hadn't been a lot of big IPOs in a few years. I thought Google did something fairly unique, given its dedication to its employees and their financial health, is that you were invited here, not here in the New York office, but in Mountain View, in California, to talk to the employee base about the markets and help prepare them for what it meant to have, wealth in the market. What was it like speaking to Google 2004?
Actually, my first time at Google, I had two main impressions. First of all, I've been an academic most of my life, but started my investment career as an investment banker in New York. And as I got into this business, we had a training program of about a half a dozen guys, and we were going to be given a lecture by the senior partner of the firm, and the air conditioning broke in the building. It was a building 20 Broad Street, right next to the New York Stock Exchange. And so we were all coat and tie, obviously, and I and the other trainees took their coats off. The senior partner then started to address us and said, it's okay when the air conditioning breaks that you can take your jackets off, but then looked at one of the trainees who had a short sleeve shirt on, but never, never, never take your coat off if you've got a short sleeve shirt on. So this is how I came into the business world. So you can imagine my first impression of going to Google, of what an informal place this was. People had T-shirts, shorts, flip-flops. People were throwing Frisbees inside the building. There were dogs running around. And, I couldn't help but think back to the beginning of my business career, and I say, oh, my God. I knew the West Coast was always less formal than the East Coast, but what a difference this is. And I also visited at the time because I had known him. I'd been on a couple of panels with him. Eric Schmidt, who was then the CEO, was a Princeton trustee. And here was Eric Schmidt in this little tiny office, and I was thinking of the partners' offices in the investment banks. And so the first impression was, my God, what a different world this was from the world that I grew up in. I think the second impression that I had, when you go into the Google headquarters, there's this huge map of the world with lights. And every time somebody does a search in whatever part of the world it is, a light goes off. So you're looking at this sort of map of the world, and lights are blaring at you. It's like a Christmas tree. And everywhere. I mean, it must have been 3 o'clock in the morning in Tokyo, but, Japan was all lit up. And, it occurred to me, what a worldwide phenomenon and what an amazing company this is, and what a worldwide company it is. And it also, as kind of an economist who was interested in economic development, I thought, what a way of showing the parts of the world that are undeveloped, because as you looked at the map, the only dark part was between sub-Saharan Africa and southern Africa, and there were no lights going on there, and you realize how could you better show where the world is economically developed and where it isn't. So those are kind of my first two impressions. It was an absolutely wonderful experience. We're giving up parts of my Random Walk book, and at lunch, Mario Batali was there, and he was cooking for all the Googlers, and I traded books with him. And, it's one of my, you think of the unforgettable experiences in your life, and that was one of them, my first visit to Google.
Yeah, well, it's fascinating because Google came public, like I said, a few years after the first big market crash, right? The kind of 2000 to 2001, at least the big market crash in recent memory. And then just a few years later, of course, in 2008, we have the massive financial dislocation. And this is a question for both of you, but how do you feel that affects the advice that you give people, or how they receive it now that they've been through not one but two of these big events?
It gathers the attention. It depends on your own perspective. We're both of us at an age cohort where been around long enough so you can't help but think about times way back and stuff like that. Markets go up and down. And Mr. Morgan was once asked, what do you think of the stock market? He said, it will fluctuate. And sure enough, still does. Sometimes it fluctuates like a punch in the face, and sometimes it's like a beautiful woman's soft touch. Everything is working out perfectly. But most of the time it's just sort of wobbling around out there, and I think it's dreadfully dangerous because it attracts your attention. And candidly, the best line ever given about the market was, frankly, madam, I do not give a damn. None of us should be paying attention to the stock market nearly as much as we pay attention to ourselves. If you know who you are, where you want to go, you will do more good for yourself than if you know all about the stock market. Partly because it'll disappear, because markets are very temporary and gone. But you really are important, and the rest of it is details, and the specificity and the intensity and the excitement of the details can attract attention. But if you didn't know a thing about what was going on, you could still find your pathway through what's going to be going on in the long run. I assume you've read Nate Silver's wonderful book about the signal and the noise. It's a terrific book, and a terrifically smart guy who's put together an awful lot of insight and understanding. But he's right. The signal and the noise, pay attention to the signal. Don't worry about the noise. And if the signal tunes in for you in a particular way, or you can tune in with it, you can do some important value-adding decision-making. All the other things are best ignored.
And in fact, they ought to be ignored because to the extent that they affect you, they make you do the wrong thing. One of the things...
If you're a human being.
And that's where this new field of behavioral finance comes in. One of the things we know, we have very good data on the flow of money into equity mutual funds. And what we know is that money flows in when everyone's optimistic. More money flowed into equity mutual funds in the first quarter of 2000 that happened to be the top of the internet bubble than ever before. And then at the market bottom in about the third quarter of 2002, the money went out. Then the money came back in, and more money came out than ever before in the third quarter of 2008. at the height or the depth, if you wish, of the financial crisis when everyone thought the world was going to end. So the problem with looking at the noise is it makes you do the wrong thing. You're selling when, if anything, you should be buying, and you're buying when everyone is very optimistic, and if anything, you should be careful. And that's the real problem of letting the noise affect you rather than simply if you're saving for trying to build up a big retirement nest egg, of just doing it evenly over time and take advantage of the opportunities when the market's down. Not sell, but keep a steady course.
You know, oh, sorry, go ahead.
All three of us went to Harvard Business School. It's a great place to go. You can learn a lot. You can take the course on investment management. You can learn a lot. You'd learn more if you could just take 5 years and be a parent of a teenage child. You realize it's very exciting. It's very interesting. It really gets you excited positively sometimes. It gets you very excited negatively sometimes. And it doesn't matter. They grow up to be wonderful, long run.
Yeah, my teenage years weren't so exciting, but I may have done it wrong. I may have to do it again.
Depends. Exciting to you or exciting to your parents?
I'm sure it was exciting to them.
I would have thought they'd have been really deeply afraid.
They're still trying to figure out how their son ended up in a career where he doesn't have to dress up every day.
Right.
So no, actually, I like this focus on long-term and investing. I see a big parallel. The great technology companies have always been the ones that got out of the day-to-day, quarter focus, even when public, and focused on initiatives 3, 5, 10 years out. I mean, Larry's done that here at Google. I think Jeff has done that fantastically well at Amazon. I think that's rare, but the great technology companies know that technology reinvents the rules every few years, but it's fairly predictable that scale will increase, speed will increase, and what's now possible. So a lot of the folks in this room, their first job may have been at Google or they may have been at other technology companies. You were both involved with Vanguard in the very earliest of days. And for most of the people in this room, Vanguard is a huge fact of the financial industry, right? Trillions in assets, index funds. It's a staple of what people think is available. But that wasn't always true. Vanguard was effectively a startup as well. Do you guys want to comment on?
Well, we differed on that. Bert wisely said, I think this could work, and worked with Jack Bogle to make it go. And I unwisely went to Jack and said, Jack, you made a terrible mistake. You're in a short, dead-end street. It's not going to work out. All of your friends know you've really screwed up making this commitment. If you just stop now and come back into the normal world, you'll be okay. Forgiveness is a part of the investment management world. On the whole, Bert was dead right. On the whole, I was dead wrong.
No, but the fact is, when I first wrote my random walk book, which is in all of these editions, was actually 1973, and it recommended that people would be better off with index funds. And I had a market professional review my book in Business Week, and it's the worst review I ever got. They said this was the biggest piece of garbage that they had ever seen. And when Jack started the first index fund, it was called Bogle's Folly. And in fact, I sometimes like to think that Jack and I were the only two investors in the index fund. It was very slow to start. It wasn't that this just took off right away. It didn't. It was years and years before it had any significant assets. And again, that just shows you the importance of it was right. It has, in fact, it's not been, people say, well, who wants to be mediocre? It's not mediocre. It's being above average, being in a low-cost index fund. And after a while, it did start to take off, but believe me, it was very, very slow, and people thought this was the stupidest idea in the world.
There were advertisements taken out in a trade magazine index funds are un-American. And it was run over and over and over again because it got the laughs, but it also was what people really felt emotionally.
Well, it's hard to accept that, I think it's seductive to believe that you can outsmart the market or figure these things out.
Well, could I interrupt you just for a
yeah.
second? If you're trying to outsmart the market, that's self-deception. It's not as though the market is out there doing whatever markets do. There's a smart son of a bitch on the other side of every trade. And when we were children and just getting started in investment management 50 years ago, 92, 94, 95% was done by individual investors. Now, what's an individual investor? Well, he makes a trade every year and a half. Every year and a half, one trade. Why does he buy or sell? Well, he buys because he got a bonus of a couple $1,000s, or he sells because he wants to help his daughter pay for college. It has nothing to do with the stock market. He doesn't do any comparison shopping. He buys, half of them bought AT&T, and then half of the rest bought the company they work for, and the rest bought some company they'd heard about that must be a good company because one of their friends told them about it. Now, honest to goodness, it's not hard to beat people who have no access to information or research, have no comparison value, aren't doing it with anything like rigor or analysis. They're just kind of, well, I've got some, why don't I buy some? Today, it's not 95% done by individuals. It's 96% done by experts. 48 of the 96 are done by the 50 largest, most active investors. These are people that really care. And they've got terrific equipment. They've all got at least a couple of Bloombergs, usually have one at home, one at the office. They've got tremendous access to factual information. Everybody gives them the first call. Everybody wants to do business with them. They are so actively in the market so much of the time, and they've spent years mastering the company or the industry that they're working in. And when they get you in the crosshairs, well, it was all well and good when George Plimpton would go out and play against the NFL team. But personally, if I were to go out, that would be the way I would be. I'd be absolute bait for destruction. And same things in the stock market. If you take on these guys, they're really good.
Well, it's
and
ironic.
they're killers.
It's ironic that a good
Wait,
low-cost diversified portfolio beats a lot of these.
You don't have to take them on. You can let them do all the work. All the work. And the rest is on automatic. And that's basically what index funds are all about. After they've figured out what the prices ought to be, and there's a lot of work on price discovery, and they get really good at discovering the prices. Once they've figured it out, say, fine, I'll take what they've got. I'll have what she's having.
Well, what's fascinating to me is, Wealthfront, our average customer right now is in their 30s. A lot of 20-somethings, 30-somethings, 40-somethings. They tend to be more technical. And they've been through these two market crashes. So the thing that I hear over and over again from folks I like to talk to customers is that they don't think they're going to make their money by beating the market. They think they're going to make their money by being a great engineer or a great designer or building a company. They just want to have their money soundly invested in a low-cost way. When you folks talk to young people now, I know you're both involved a lot with different groups and teaching. How do you give advice to folks in Gen Y, Gen X, young people who are at early stages in their career?
Well, I generally tell them to put money into their investments regularly over time, no matter what is happening. And don't worry if the stock market goes down. There's probably one of these professionals that Charley's talking about, and maybe the best investor that we've got in the country is Warren Buffett, and he has a wonderful essay which says, suppose you love hamburgers and that you're going to be eating hamburgers all your life. Would you like, and you're not a cattle rancher, would you like the price of hamburgers to go up or down in the future? You say, well, look, I'm going to be buying hamburgers. I just assume the hamburgers I buy next week and next year are lower. Say, okay, you got that one right. Okay, here's the second part of the quiz. Suppose you're going to be buying automobiles all your life and you're not an automobile manufacturer. Do you want the price of automobiles to go up or down? You say, well, I just assume the next auto I buy is actually cheaper than the one I just bought. And Buffett says, good, you got that one right too. Now for the final exam. Suppose you're going to be investing all your life. You're going to be putting money aside all your life. Do you want the stock market to go up or down? And Buffett says, this is where people generally flunk the final exam. It's only if you're in retirement and taking money out that you want the stock prices to be high. It's as if you're asking that the hamburgers that you're going to be buying and the cars that you're going to be buying are going to go up in price. In fact, through something that's, it's actually the technical term for it is dollar cost averaging. If, in fact, the price goes down, your money goes even further. You can buy more shares. And you can put a little example down of how even when the market is very volatile and doesn't go up at all, you can make money because you've bought more shares when the market was down. And one of the simulations that I've done is take a decade of the first decade of the 2000s, which has been called by investors the lost decade, because in general, if you put money in the S&P 500 on January 1st of 2000 and looked at what it was worth on December 31st of 2009, you didn't make any money. That was the second decade's been pretty good, but the first decade was terrible. But if you put money in every quarter regularly, you actually made a pretty good rate of return even during the lost decade. So what I try to tell people is generally put the money in steadily. Nobody can time the market. Professionals can't do it. Look, I've been in this game for 50 years. I've never known anyone who could time the market. I've never known anyone who knows anyone who could time the market. It's not that the efficient market hypothesis means that prices are always right, and that's how some people poo-poo the idea. Prices are not always right, they're always wrong. The problem is no one knows for sure whether they're too high or too low.
Yeah, I think what I love about that advice is it highlights actually good financial fundamentals. It turns out the most important thing for young people is just to be saving. They save regularly, put it in the market. It's actually better for them if the market has up and down, because they'll get some of the downs. True, you get some of the ups, but the long-term trend is obviously their friend. Sorry, go ahead.
I'll just adjust that a little bit. Saving is number one.
Yes.
Not getting excited, either at the top or at the bottom, is number two. And then regular investing, ho-hum, steady, 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 number three. And it works out fabulously. But it takes some self-discipline when the excitement around you and all the people are talking and the newspapers and magazines and television programs are talking about it. This may be the last chance to get in on wonderful opportunity.
Yeah, well,
and it's very hard not to get deeply concerned when you see the whole economy's falling apart, Asia's going wrong, Europe's going wrong, the president's having a terrible time, the president's wife is unhappy with him, your wife is unhappy with you, and your friends are all deeply concerned, and the food doesn't taste good. It's pretty hard not to get depressed, but you got to hang in there because that's the time of your best chance of your lifetime.
And control the things that you can control. You can't control the ups and downs of the market. You can control your costs. You can control your taxes that you pay, and you can use the best friend you've got for reducing risk, and that's diversifying. Mm-hmm. So diversify, control the things that you can control, and as much as the market might fluctuate, don't worry about it. You'll come out okay.
I think it's such good advice. Ironically, I think in some ways we've made it harder on ourselves in this generation. We all have smartphones in our pockets. They buzz all the time. We're checking our feeds, whether it's Google Plus or Facebook or Twitter. There's stuff happening all the time. So learning that basic fact that there are some things you can control and some things you can't. It's really important with investing.
One thing that gives an easy metric on this is never do nothing that you're not prepared to hold on to for at least 10 years, whatever it is.
10 years. Well, I think, actually, it's a good segue. You did an interview, I think, recently with, was it Investor News or Institutional Investor, where you talk. I think the title of the article was, "Is Alpha Dead?" Right? And I mean, compared to 40 years ago, do you feel like, is it the same as it's always been? Has it got even harder to beat the market? Is it, how do you reflect
50 years ago, it was relatively easy to do better than the market rate of return because the competition wasn't very good.
Mm-hmm.
Today, the competition is just marvelous. Every time you buy from somebody who knows a hell of a lot about it. Every time you sell something, you're selling it to somebody who knows a hell of a lot about it. They may make mistakes, but how smart are you that you won't have made at least about the same number of mistakes, plus the cost of being there in the activity. So the world has changed. And Keynes said one wonderful sentence: when the facts change, I change my mind. What do you do about yours? And it's worth thinking about. And the world of investing has changed. And so what would be sensible 50 years ago could now be not at all sensible. And all the evidence is that it doesn't work to do what would have worked 50 years ago. Fine.
Mm-hmm. Well, I think it's, I think it's magical in some ways that we've evolved the industry to the point where you can own the entire U.S. stock market for such an incredibly cheap rate. I mean, 5 basis points is kind of amazing. It's good to know that even in this arms race that's going on amongst the professional investor set, that you can do better than most of them just by buying the simple index funds. Let me segue a bit, some kind of topical news. Federal Reserve has been in the news a lot lately. Both of you have had careers. You worked with Alan Greenspan at one point. Ben Bernanke, I think even Janet Yellen we were talking about. Any comments about what the differences are, or what it takes to be a great Federal Reserve chairman? I mean, it's something you can only really look over decades. It's not something you really understand just looking at the most recent candidates.
Oh, I think there's some things you could say. Number one, Federal Reserve governance is a team sport.
Mm-hmm.
So if you are not really good at working with other people, you got a real problem. Secondly, I think you could easily say we have been really fortunate to have some extraordinary people serving in the governorship, but particularly the chairman. You should talk about Ben Bernanke because you really worked closely with him and knew, but I knew Janet Yellen quite closely at Yale because these are extraordinary people who have studied and studied and studied the field in which they are then put to test. Everything that they live with is new, difficult, fast-moving, and the data is not available. So it's a really tough job. But if you wanted to pick people who are wonderfully well-suited to that, out of all the people that might be chosen, we've been very, very fortunate as a nation. And it's wonderful that the rest of the world has very talented people in their central banks also, but that these people talk to each other all the time, and the factual information that's accessible to the bankers is terrific. Is it perfect? Certainly not. Is it a hard job? You bet. And unwinding this massive purchase of mortgages is going to be an unbelievably challenging. When do you do it? How do you do it? How do you communicate about it? It's going to be hard.
I would agree with you, Charlie, that the consensus building is so important. And, Ben came from my university, and so I've seen Ben in action herding a group of prima donna faculty around is not one of the easiest things in the world. And Ben was a brilliant department chairman. And I think Ben was quite brilliant as the leader of the Federal Reserve. And I think one of the things that is very likely to be the case for Janet Yellen is that she has some of the same qualities. So I agree with you that we've got a big enough government portfolio that there are really some questions about whether we have done something to hurt the market. Unwinding this, which is certainly something that needs to be done, is going to be very, very tricky. But I think we've got the right people on board to do it.
It's good to hear. A little bit of good news. Before we open it up to questions, because I know people must have quite a few, I wanted to make sure to ask, a fundamental one. You've both been a part of some very fundamental improvements in the structure of the industry. What clients deserve from their advisors, index funds, passive investing. I mean, just a wide range of advocacy for making investing better for individuals. How do you think about your legacy or what you want to make sure continues going forward, given the progress that we've been able to make over the last few decades?
Well, one of the things that I have worked on recently is to try to see if we could get the whole industry to sign on to something that's called the fiduciary standard. And it's sort of very simple, that you don't do anything for your client that you're not absolutely 100% convinced is in your client's interest. And that's basically what I think is the fundamental problem with the industry, that there is this severe conflict of interest. I mean, this is one of the things that happened, in the financial crisis. If you are making a lot of money selling mortgage-backed securities, well, we're not going to worry what kind of toxic stuff is in there. If people want to buy it, let them buy it. That was basically what the industry did. And I think what is the answer is what informs every decision you make is not whether it's good for me, whether it's going to be good for my bottom line, but whether it is good for the bottom line of the people we're serving. And if I had a legacy that I wanted to leave on my tombstone, that would be it.
Charley?
I don't believe in legacy. I'll just say, read what Bert wrote in his tombstone. That would do fine. Well, it's a cultural problem. If we get enough misbehaving, we'll get enough corrective so that the culture will move towards doing the right sorts of things. But once you separate the professional value from the economics of the business economics are going to take off and get to be dominant, and it'll attract people who say, you get pretty good pay over there, and it doesn't look like all that boring work, so I'd like to do it. And that recreates. If you go back and read economic history in the 30s, there were some marvelous hearings in Washington where one banker after another was embarrassed, something unbelievable, to be asked a series of questions, the Pujo hearings. And it's kind of fun to read back over that. And gee, it's so similar to what we did. And in the last round, it's 2008 and the break in the market, you can trace an unfortunately large fraction of the really severe difficulties to very specific individuals who misbehaved. And it wasn't the people down the line that did the worst of it. It was the people at the top of those organizations that did the worst of it. And that's a shame.
Mm-hmm. Well, I think I have more questions, but I want to make sure, just given the time and also that we...
I have one that I want to squeeze in because I'm all excited about
Sure,
this.
yeah.
As you've heard, I've been around for a long time. And I'm sitting in an investment committee meeting, and we're getting a review by the manager of why it didn't happen to be their particular kind of market, and it just happened to be that instead of doing better than the market, they happen to do slightly less well, but they've done some wonderful things to improve, and they're going to be able to do terrific in the future. And I'm looking at the numbers, and I realized, never actually realized it after 40 some odd years, 48 years, I hadn't realized what the fees are. Now, most of us in this room would be able to say, oh, fees are small. Fees are really small. It's usually a four-letter word and a single number. Only is the four-letter word, and 1% is the single number. Well, the 1% is not accurate. Mutual funds typically run closer to 1.25% of the assets. But then I would turn to Bert and say, but Bert, you've already got the assets. So the fee isn't what you're paying for what you're getting, because you've already got the assets. What are you getting? Oh, Charlie, we're getting a return. Great. Normal expectation of returns here, given the market's gone up a fair amount, going forward might be 7 or 8% on average, with lots of ups and downs in between. So that 1% or a little over 1% as a percent not of assets, but a percent of the returns, what's that work out to be? Oh, let me do the math. Well, call it 15%. That doesn't sound like only. I guess not. I guess it's really actually pretty high. And then when I was in school studying economics, we all were taught everything is comparative price. So what's the commodity product and the commodity price? And then what's the custom product and the custom price? The commodity product is an index fund. It gets you the market rate of return every day, every week, every month, every year, same old market rate of return at no more, no less than the market level of riskiness. Okay, that's a pretty good commodity product. What's it cost? 1/10 of 1%. Okay, now I can get a custom tailored product, and what does it cost? Well, it costs, if it's 10 basis points for one, it's 120 basis points for the other. So incremental cost is 110 basis points. Gee, I must get a pretty good return in exchange for that, don't I? No, Charlie, I'm sorry, but you don't. Actually, you get more risk. You get a lot of uncertainty because you never know when something's really going to go wrong, but leave that aside. More risk, and on average, 3/4 of the funds that are actively managed, maybe it's 80% of the funds, somewhere in there, underperform the benchmark that they said they were going to match. And you never can figure out who's going to underperform. Most, and you can never figure out who's going to outperform. There's no way of doing it. So what you're doing when you get a custom tailored product is you're paying a much higher fee for a less quality and a lower return. And it is just amazing that that's something that continues year after year after year. And it can't last for long, but really smart people are going to figure it out and say, I'm not going to do that. I'm going to take the commodity product because it's cheaper and better return, and I've got better things to do with my time than chewing my nails over whether I'm going to be okay or not okay.
Let me just put a footnote on this, Charlie, because I've just done some work on 401k plans. And in general, the cost is more like 2% than 1% because then there's a wrap fee around the high-priced mutual funds that are in there. And so you might say, instead of getting a 7% return, you get only a 5% return. So your way of looking at it is it's not 2%, it's really 2/7 is what you're paying. But it's even worse than that because these costs compound. If you think of putting money in at 7% for 40 years or putting money in at 5% for 40 years, that difference at the end isn't even 2/7. You're getting about half the amount at the end because the tyranny of the compounding of the costs gets you. So again, it is just so important. If you got something for it, fine, but you don't. The evidence is unmistakable that you don't. It's getting tougher and tougher all the time. The market's not always right, but there are a few Warren Buffetts. I sometimes say, if when I wrote my book, I knew that Warren Buffett was going to be Warren Buffett, I wouldn't have said buy an index fund. I would have said go buy Berkshire Hathaway, which is Warren Buffett's investment company. And you know what? There will be Warren Buffetts over the next 40 years. There'll be maybe 5 or 6 of them. Could very well be. But as you said, I don't know who they are, you don't know who they are, and when you try to go for them, you're much more likely to be on the negative side of the distribution, and you're going to be a loser. So index investing isn't mediocre, it isn't average, it's way above average.
Yeah, well,
one place that I would differ slightly from you, Bert, same conclusion. You say you would only get half as much if you went active as opposed to index. I'd just like to turn it around and say the other way. You get twice as much at the end of the run.
I won't argue with you at all.
Instead of
Won't argue with you at all, Charlie.
Well, I'll tell you guys, this is great because my background is in software as an engineer, and I focused on human-computer interaction. But I'll tell you, after joining Wealthfront, finding ways to explain to people that 1% to 2% is actually a really big number is one of the hardest problems that I've run into.
Say that to a balloon that meets a pin. Beautiful big balloon, one tiny little pin.
Albert Einstein said that compounding is the greatest force in the world. Well, the costs compound too,
right.
And that's what gets you.
Yeah.
Now, before we leave it, could we just all agree that nobody should ever use credit card debt? Because not only is that a big interest, but boy, when that compounds, it really goes.
Yeah, when people find out that debt compounds just the same way with much bigger interest rates, it's usually a real depressing outcome.
Wow.
So great. So I think in terms of time, we wanted to leave some time for folks to ask questions. We have microphones set up for the folks who are watching remotely. Feel free, and I'll just call on folks. Maybe your name and who the question's for.
Sure. My name's David. A question for Bert. So you said earlier you can control the taxes that you pay. I'd love to know how.
Basically, you can control the taxes by something that's called tax loss harvesting. If you have a portfolio, let's say that you just have a portfolio of U.S. stocks, or even U.S. technology stocks, and it's an index. There are always going to be a few of those stocks that have gone down. You've got Google that's gone up. You have Groupon that went down. So what you do in tax loss harvesting is that you sell the loser and put an equivalent one in. And we can do this with index funds. We have a diversified portfolio of U.S. stocks, of international stocks, of developed countries, of emerging market stocks, of foreign bonds. In other words, we've got a whole bunch of asset classes. So in a period such as this past year, where the U.S. stock market has gone way up, but emerging markets have actually gone down. Emerging markets have been weak this year. You sell one emerging market index fund and buy another, so you keep the exposure, but you recognize a loss, and that loss is deductible from your taxes up to a certain amount, or could be used to offset other capital gains. So it's the harvesting of the losses that is a way of controlling your taxes. And again, up to a certain amount, even if you had no other capital gains, you could deduct this on your 1040 for the year.
This is one of the things that humans can do. If you're really on top of it, you'll see advisors do once a year. You always see the articles and papers about harvesting some losses in the end of November, somewhere between Thanksgiving and that 30-day window. Wealthfront, because we did it in software, we can actually look for those opportunities every day. It just turns out that the computers never sleep. But yeah, it's a great technique, there's no question. Go ahead.
So, hi there. My name is Dor, and by the way, I'm from the Yale School of Management, class of 2013. So, very nice. By the way, the same thing is taught at Yale, so also double thumbs up on that. My question is about diversification. So, I somehow can't believe the answer is invest only in index funds. It seems like, I mean, although index fund by its definition is diverse because it spreads, it invests on many different things, it's as if you don't diversify your risk. And my question is, what would you say to that?
Well, you are diversifying your risk using index funds. I mean, a lot of people will tell me, because I believe in buying index funds for emerging markets, and a lot of people will make the following argument. Look, emerging markets are very inefficient. Information isn't, in fact, as available for each stock as it is in, let's say, the United States market. And that's absolutely correct. But when you look at the data, over the last 10 years, and it's not 2/3 over that period who were worse than the index. It was basically over 90% of active emerging market managers were worse than an emerging market index. And it was in part almost because of the inefficiency. The trading markets are very inefficient in emerging markets. There are big bid-ask spreads. So if you trade, you're paying a big gap because you're always buying at the asked price and selling at the bid price. There are stamp taxes in emerging markets, so that there's an extra tax when you trade. When there are so-called market impact costs, there's so little liquidity, so it's not like buying 500 shares of Google and you don't move the market. You move the price against you. And so even in markets that seem less efficient, the markets are going to move. Different markets are going to move differently. Emerging markets are very unpopular. During that lost decade, when the U.S. market did nothing, emerging markets did 10% a year. During the last year, the U.S. market is up 15+%, and emerging markets were down 4 or 5%. So there is the opportunity for tax loss harvesting. There is the opportunity for diversification. And I don't see why you have to go to individual stocks to get those opportunities. I think they're still there with index funds as long as you're in different markets that react to different economic realities.
Hello, my name is Jeff. You talk about dollar cost averaging and investing slowly over the course of one's life. Excellent advice, but it's sort of one-dimensional. And so suppose that over the course of an investment lifetime, I have several different index funds, US indices, emerging market, whatever. And over time, I say, well, maybe this index here isn't really the best one to have, or I don't think it's got the best future, and I'd like to shift my focus. And I'm curious how you see that sort of reallocation, like what's the right way to reallocate, or even to do it at all, because there's this element of, well, you shouldn't think about that, you should just keep plodding forward.
Well, I think you should think about it, and this actually gets to another thing that we do at Wealthfront that I think is extremely valuable. Tactical asset allocation, which is, gee, this market looks, gee, I don't like China now. I think I ought to be in Brazil. Or I don't like emerging markets. I think I ought to be in the US market. I think that doesn't work. I've seen many professionals try to do it. I think it simply cannot be done. But what you can do is rebalance. And what rebalancing does is it simply says is, let's say you thought your portfolio ought to be 75%, or let's say 50% U.S., 25% developed foreign, 25% emerging. I'm just making up the numbers. And then what you do is at least once a year, you rebalance to that. And what that makes you do is it makes you take some money off the table on the market that did particularly well and makes you put the money back into the market that did relatively poorly. If you want, it's the opposite of what people do, because what people actually do is they put more money into the market that did well and take the money out of the market that did poorly. And my own work suggests that rebalancing over the last 15 years, and just once a year, very simply, added between 1 and 2 percentage points to your return of a diversified portfolio. And that's one of the other services of Wealthfront, is that we do a systematic rebalancing. I understand the argument, couldn't we do it tactically? And I just don't think anybody knows how to do it. I don't know, Charlie, what your view is.
Well, there are people who know how to do it, but only briefly.
Right. Not consistently. I mean, there'll always be people who get it right once in a while.
Yeah.
Thanks.
Thank you.
Hi, my name is Tom. I was wondering, as more and more people seem to take your advice and use sort of a passive approach and stop picking winners and losers, does it ever become a tipping point in the future where it sort of becomes the 1950s again, and since no one is paying attention at all, it actually becomes possible to pick winners and losers?
Yeah, there is a point at which it becomes, once again, a terrific opportunity. It's that time when people say, I'm not going to be an investment manager. There's no point in it. The pay has gone down so badly. You can get much better jobs doing something else. It's going to come at a time when the securities firms don't have analysts that are pumping out tremendous amount of factual information. When Mike Bloomberg says, you know, we're going to pull back all those machines because nobody's subscribing anymore, we're going to junk them. There is a point. But walk through the mathematics. Typical index fund will have turnover of about 5%. The market as a whole has turnover of about 100%, 120%, somewhere in that range. So if you move 50% of the assets into indexing, what fraction of the market will that be? It's about 3%. If you move 80% into indexing, what fraction of the total market activity? You're starting to get close. When you get to 95% of the money is now indexed, the amount of opportunity off indexing would be high, but by then, all those sad things I was talking about earlier, of people saying, this business is over, I can't get a job, I can't get any equipment, I can't get any services, the hell with it. Then we'll be back with grass growing through the streets of New York, and we'll have all kinds of opportunities for people to get into active investment management, but they'll be alone. And they won't be able to get the services and help, and so it won't work for them anyway. I mean, this is one of those marvelous, mythical questions that I love you're asking it, because it's a setup in the reality. The math, it just doesn't work. That there will come a time there's so much index that somebody ought to be really out there doing active investing.
And where
Besides, indexing has grown. I mean, it is getting close to 25% of individual money, and probably close to a third of institutional money is indexed. And when it gets to be 95%, I'm going to worry about that question, but I'm with Charlie. I don't think that's, it's a good theoretical question, but I don't think it's ever going to happen.
You know that old poem, breathes there a man with soul so dead, who never to himself has said, this is mine own, my native land. Well, it's the same thing with active investing. We all believe we can do better. We all know from all the other experiences that we have in our lives that you can do better. It just happens in this particular one, if you're trying to do better, you're up against an invisible competition that is so damn good that it doesn't make sense to be doing it. And I'm back to George Plimpton going out and playing in the NFL. Nice guy, reasonably strong, reasonably healthy. He was 6 foot tall. But you could get killed out there on the line playing against a guy who weighs 300 pounds and does the 10-yard dash. Who wants to do that? Same problem.
Yeah. We have a bunch of questions in. It's a great question. We have a bunch of questions in from remote viewers, so you can see them ranked by popularity, so I'll just read a couple of these. The first one's actually a great one. It says, bonds are scary because interest rates are low, and stocks are scary because the economy has high unemployment, and profits are at an all-time high due to a lot of cost cutting. Peter asks, what should he do with his cash?
Well, I think bonds are scary because I think when you look at our dysfunctional government and when you look at how hard it is for us to rein in our budget deficit and do something about our long-run budget deficit, you realize that we've got a very high debt to GDP ratio, and the government's got to do something about it. Well, what the government is doing is something that goes under the name financial repression. We are keeping interest rates very, very low. The last time the 10-year Treasury yielded about 2.5%, which it yields now, it's actually up to 2.7 right now, but it's somewhere around that, was in 1946. In 1946, we had a debt to GDP ratio of 133%, much higher than it is now. And we were trying to finance that deficit and keeping interest rates very low. Well, we actually had interest rates pegged into the 1950s, and then we let them rise very, very gradually until 1980. And what happened in 1980, we had a moderate inflation. It was a little bigger, and there was an oil and food shock in the 70s, but in general, it was a moderate inflation. And the debt to GDP ratio of the United States in 1980 was 30%. So what this financial repression does is it's a way of getting rid of your debt, of letting inflation inflate it away, and you do it on the backs of the bondholders. And I am very worried about that. And we at Wealthfront have I think some very interesting strategies in our asset allocation. For one thing, we use for part of what might be the safer bond portfolio, which is still needed for people, particularly those who worry about volatility, is we use an equity substitution strategy. And by that I mean we try to use very safe, high dividend growth stocks to substitute for the bond portfolio. Just to give you an example, AT&T stock yields something over 5%, and the dividend on AT&T has been growing at 5% a year. My guess is it won't grow at quite that rate in the future, but it's likely to grow. AT&T 10-year bonds yield 4%. Now, I can't believe that you won't be better off as an investor with AT&T stock. I think you'll get a higher rate of return. And there was a time when bond prices and yields were adjusting in the 1970s when bonds were more volatile than stocks. So that's some part of it. Another part of it is to look at some foreign countries with budget deficits under control and with debt to GDP ratios low that have higher yields. So we're very conscious of that and have adjusted the asset allocation to take advantage of that. Stocks are scary. They're always scary. Profits are at an all-time high. On the other hand, because we have high unemployment, I don't think is a reason to be negative on stocks. It means we've got a lot of excess capacity, and we could, in fact, grow as a nation at a much faster rate in the future. In fact, my own economic forecast is we've been growing at 2% a year. I think we're very likely to see in 2014 a growth rate that's over 3%. So I think that's actually an argument for stocks, because I think you're going to see more growth in the future than you have in the past. And in general, our portfolios, particularly for young people, are very much equity oriented, and we've been very careful about the bonds with some of the ideas that I gave you earlier.
Can I add on to that? Because
Sure.
it's really worth thinking about. Being young is the best competitive advantage you could possibly have as an investor, because you've got time. The big problem is you haven't been around long enough to realize what a terrific thing it is to be young. Okay.
Is wasted on the young?
You can
You mean?
you can read Bert's book and that'll catch you up, but it's a huge advantage to have time on your side. And most of the people here are going to be investing and buying securities and buying houses and buying art and investing and accumulating for the next 30, 40 years. Most of you work to 75. You'll enjoy the work so much you won't want to stop. And we'll move retirement ages out. So 75 is a reasonable bet. Most of you are under 40. So you got a long shot. Even when you retire, you're going to live for another 20 or 25 years after that. So your average length of time between now and when you sell them to pay for your way of living is not 35 years, it's 45 years. Nobody who's got 45 years would say, ooh, let's buy bonds, unless they're anxious about ups and downs in the market. If you just keep your vision on the long distance and don't worry about the ups and downs in the market, that's a calm under pressure. It's a tremendous advantage. Let me try one more dimension of this. Everybody in this room has got a job. Everybody in all the other rooms that are tied in has got a job. With a damn good company. Interesting place to work. Probably all are super smart and know that they could easily walk across the street and get a terrific job at another really interesting company anytime they wanted to. So security with regard to earned income is very, very high. The only thing you don't know is how rapidly you will rise in that earned income. You know, 5 years from now, it's not going to be less than it is now, unless you happen to shoot the lights out with some spectacular bonus, and that's a once in a lifetime. Leave that aside. Salary and regular bonuses, whatever, compensation, it's going to go clunkety, 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 clunk. That's essentially an income that is fixed on a slope, but it's fixed. Think of that as being a bond equivalent. 5% is a reasonable interest rate. Okay, multiply your salary by 20. That's how much you've got in fixed income right now. That is such a big fraction of your total wealth compared to what you've got in securities investment. Look at the whole picture. And I believe you will say, I want to reconsider how much I have in stocks versus bonds, because now that I realize I've got a fixed income that is huge, I'm way behind on what I ought to do in the stock area. I think most people who are in their 30s and 40s should be thinking seriously how much emotional stability they've got up to that level that they can live with. They should be piling everything they've got into equity type investing rather than into fixed income investing, because they're stuck with their biggest thing they've got. Their biggest value is their intellectual property. The ability to come into an outfit like Google and say, I'm here and I'm willing to work with you. What a fabulous sentence that is to be able to say out loud. No, recognize the reality. Your intellectual property value is very large.
People in general underestimate the value of that human capital asset. You know, a lot of the people in the room, technology industry, we spend so much time keeping our skills up to date. We learn the new languages, we learn the new platforms, we learn new solutions to old problems, but that doesn't always factor into how people think about money. I want to be careful because we have a couple more questions on time. There's one that I see highlighted in blue. I'm assuming that means I'm supposed to read it, so I assume blue is good. We talked about this briefly, but for folks in the audience who may have a lump sum or have been out of the market in some way, What are your opinions about lump sum investing versus dollar cost averaging?
I think it's a great idea to put everything you've got on the number that's going to work out really, really well. When you're gambling, that's exactly what you should do. And in investing, if you just have the ability to time the market, you should definitely do it. If, on the other hand, you're like all those boring people that Bert and I know, real human beings who could easily be misled and would rather settle for normal, break it up into parts and spread it out over some time. Don't try to be too cute and clever. All you do is hurt yourself. If, for God's sake, you're right, you'll then think, hey, you know, Bert, I'm really good at this. I think I'll do it again. And you'll get hit that time. Worse than that, you're right the second time. Now you're really in trouble because you'll honestly, God, believe you could do it. And we'll get you.
You don't get good at coin flipping? It doesn't happen? Bert, do you have anything to add? Or?
No, I think that says it very well. And as I suggested to you, there's a little example that I give of a market that's very volatile over 5 periods and ends up exactly where it is, but goes down first, and another market that goes up consistently, and you're actually better off with the market that was very volatile and can make even more money. So, and it's much less risky.
Yeah, the great thing about dollar cost averaging is that you know, you get in the habit of putting money in that first time that you realize that the volatility actually works for you, right? That you ended up putting in money last month and now the market, that good feel, you realize it's actually a very boring process. You put in money continuously, let the markets do their thing. I think there's one more question here.
I'd like to get your thoughts on how indices are composed, whether or not they be market cap based, fundamentally based, you know, equal weighting, anything like that. Just you know, what do you think of those?
In general, I believe in market capitalization weighting because, and this actually gets to one of the other questions that's on the screen that you didn't read. When you think of it, let's say you disagreed with me and you thought that markets were really quite inefficient. You still ought to be an indexer because investing has got to be a zero-sum game.
Minus the cost of playing the game.
Well, yeah, it's and if there's somebody who's got all the stocks that went up more than average, somebody else has got to be holding the ones that went down. But in fact, it's a negative sum game because of the costs involved. So the first thing to remember is once you stray from all the stocks in the market, which are weighted by their market capitalization, that is what the market is. You are making a bet, and maybe you would be right, but then somebody else has got to be wrong. Now, what all of the other things do, whether it's equal weighting, whether it's fundamental indexing, whether it's value investing, is you put certain tilts into your portfolio. Fundamental indexing has been very popular. There you weight by the company's earnings or its sales or its book value. And what that does is it puts 2 tilts into your portfolio. It makes your portfolio slightly more small cap than large cap, and it makes your portfolio slightly more, quote, value, if we define value as having lower price earnings and lower price to book value. There have been lots of periods where those tilts have worked, and there's a big dispute in the academy. Is it because markets are inefficient, or is it because of risk? I think the people who favor these sorts of things better think it's risk, because if it's an inefficiency, somebody's going to arbitrage it away in the future. But let's say you believe in that and that's what you want. I don't. I want to be a market capitalization indexer. But let's say you think that this is something that has worked in certain past periods. There's no question about it. And you think it's going to work in the future. If you want that, don't buy the fundamental index. buy a Vanguard value index at a very, very low fee, realize what tilts are in those kinds of portfolios, or buy small cap, which is in fact what we've got some weighting of small cap in our overall portfolios, and buy it at a low fee. Don't buy these things that are advertised like fundamentally index-weighted portfolios, because they've got a much higher fee, and it's great for the purveyor of the investment product and not so good for you. And look, I think all of us who talk about the stock market need to be very modest about what we know and don't know about the stock market. But the only thing I'll tell you that I am 100% sure of, and that is that the lower the fee I pay to the purveyor of the investment product, the more there's going to be for me.
I see we have a couple more questions up here. I think the next leading question is, I think it's for you, Bart. I think it's you are affiliated with... Oh.
No, Charley is as well. Charley can take that about Rebalance
we have,
IRA and
we
Wealthfront.
have two firms, Rebalance IRA and Wealthfront.
Both of us are on that advisory board too.
Both, if you want to compare or talk about it.
No, I just think in both cases there's an effort to bring cost structures that are high, to go past them with a different cost structure that is low, and trying to deliver access to value. That's why we were at Vanguard. That's why we're doing this. It's very much the same thing. You can get really upset if you spend very much time realizing how much wealth has been created for investment managers by the game that's played. And try to find the wealth that was created for the clients or the customers. And on average, it isn't a wealth creating, it's a wealth diminishing activity. And if you get irritated about that, you start looking for opportunities to do something about it. And that's, I think,
the finance industry has grown in its share of U.S. GDP from 4% to 8%. And, you know, some of it is devising all of these derivative products and so forth that practically blew up the world. But a third of it is this increase in financial advice, mutual fund fees, and that Charley and I think actually is an increase in fees that, as I often say, I can't think of any service that is priced at so high a level relative to its value, which I think is very, very low. There was a famous book that was written in the Depression of a person visiting New York, and at that time in downtown New York, there were a lot of yachts on the Hudson River. And this visitor came down to visit Wall Street and looked at these and asked the guide, whose yachts are those? And the guide said, oh, those are the yachts of the Wall Street investment advisors. And the fellow asked, well, where are the customers' yachts? And I think that's the question that I would raise, is where are the customers' yachts?
Well, you know, it's funny. I think the macro trend you got right. It's the biggest sea change that's happening, and it's been happening for decades, is people recognition that they don't have to pay those fees, that index investing is the right approach, that a low-cost diversified portfolio is the right approach. You know, if I were to just, add, Rebalance IRA, Wealthfront both have that idea. The average financial firm right now is spending all their effort looking after baby boomers and retirement because there's this amazing wave of people focused on that problem. Wealthfront, we've focused on a different audience, which is really young people, tech savvy, who have slightly different concerns. They're more focused on things like taxable accounts because they're still accruing a lot of wealth. So we've invested in features like tax location. What portfolio you should have in a taxable account is different than a portfolio for a retirement account. We've invested in tax loss harvesting, which is really something that only makes sense outside of an IRA. It doesn't make sense inside an IRA. But I think the basic spirit is the same, which is the truth is more investors would be better off taking advantage of low-cost, diversified portfolios, be smart about taxes. I mean, I'm borrowing your statements, Bert. I've been trained These are the things you can control. You can't control the markets. So
let me just emphasize once again, I started off at the beginning and said we really ought to pay more attention to each one of us as an individual. My fingerprint can send me to prison because it's unique. My iris is so unique that I can go in and out of highly sophisticated encrypted facilities and they know exactly who I am because they took a camera photo earlier. In investing, we're all unique. We may look a lot the same, but we're not. We're different in age, we're different in wealth, we're different in income, we're different in anxiety, we're different in experience, we're different in how much time we've got to spend on, we're different in how much we're really interested, and we're really different in terms of whom we're responsible for, how many kids we have, how many grandkids, all that sort of thing. When you get it all figured out, we really are unique. And price discovery has been worked out, but value discovery, what's right for you personally, has not been really worked out, and that's really important. And any time that we spend on value discovery, instead of wasting it on trying to do price discovery better than the experts who are there full-time all the time, it just makes so much sense to concentrate on the value. Who are you? What are you trying to accomplish? Knowing with confidence that you don't have to do all the hard work of figuring out the right prices. It's done for you. So please concentrate on that. And after that, candidly, you've got much better things to do with your time and energy and your talent than to try to compete against the very, very, very best at price discovery. They're doing it all the time because they have to. Therefore, you don't have to do any of it, and you can get the full benefit of the very best work done by the very best people working all the time with the best equipment, the best information, and I mean all the time, working on your behalf to be sure the prices are always right.
Well, on that note, I'm seeing a signal here of the questions going away, meaning that we're out of time. But thank you, everyone, for coming out, and thank you for those online. We were happy to be here. Thank you.